to me, it seems like Jay Powell has been echoing the same message for quite some time now, months, about the lack of inflation and the Fed's intention to stay very active in markets until the economy is back on solid footing.
Yeah, I mean, it's a consistent message, which at this stage is really what the Fed has got to be giving, I think. So the inflation point, I think, resonated a little bit more in the markets. We've had more concern about inflation coming through. I think it's unwarranted. I don't think beyond an oil price base effect in the second quarter, we've got anything to worry about with inflation, with the amount of spare capacity that exists. But nevertheless, there has been a vocal debate. And so I suppose the Fed chair's comments in that regard, hit home a little harder, but otherwise it's business as usual, basically.
Paul, there are parts of the market right now that we've been highlighting for the course of several weeks here that show that the markets, at least, are indicating a pickup in inflation, or at least inflation expectations. Is there a disconnect here? Is that something technical that's happening with the financial markets, or are we really seeing some signs here outside of energy that inflation and prices are picking up?
We are getting some signs of specific prices picking up, but that's not necessarily inflation. Prices go up and down all of the time. If you look at the median inflation rate, the mean inflation rate, in other words, what are most prices doing? Most prices are doing exactly what they've always been doing, which is growing about 2 to 2.25%. So most prices are not really being shifted. But because we have got some supply chain disruption with these long, complicated global supply chains, that is causing some manufactured goods prices to spike up as demand picks up a bit. But that's not going to last, and it's not symptomatic of a general inflation issue in the economy.
Paul, as you take a look at the world economy kind of around you and your coverage universe, what is it that the U.S. is doing differently, better or worse than, say, Europe or other parts of developed Asia with regard to its policy and the economies that they can kind of move with? I'm just curious how central bank policy is affecting different regions differently based upon their own policies.
Well, I think the first point is this is not a crisis that central banks are going to be taking a lead on. I mean, essentially what happened in 2020 is governments took your money. That's what happened. And it's down to governments to give it back. This is something which requires fiscal policy far more than central bank policy. I think that there are obviously some differences. So one of the things is that the US had to sort of build a European-style welfare state from scratch, whereas Europe already had it. So you've had slightly different policy timings. And in terms of the recovery, what we're seeing, I think, in the United States, rightly or wrongly, is a lower level of fear around the virus compared to what we're seeing in Europe and the UK. And that's fear from consumers and fear from policymakers. So in the United States, we are seeing a relaxation of restrictions relative to what we have in Europe. People are more willing to travel, say, in the United States. I've barely traveled outside my house in the last 12 months. So you've got very different reactions coming through. And that's actually the main driver of the differences in economic activity that we're seeing at the moment.
Shepard Smith here. Thanks for watching CNBC on YouTube.